Hey, this is Brian Briscoe, host of the Diary of an Apartment Investor podcast and the founder of Streamline Capital Group. So a lot of people have been talking about high interest rates and how that affects, multifamily investing, the economy, and a lot of other things. So I just decided that I will give my thoughts on this subject and let everybody know what I'm thinking. So a lot of people are very quick to give projections. This is what I think is going to happen. And, I've been guilty of that as well. But, really, I think nobody has a crystal ball that can tell you what's going to happen in the future. We have a lot of data from past recessions and from past times that can indicate what direction things may go. We have a lot of correlations, like cap rates and interest rates are correlated. And there's a lot of different pressures on things, as far as cap rates and property prices, go up and down. But really, this is almost a unique time in our economic history where we are going into a recession and the Fed is intentionally pushing interest rates up. Usually when a recession starts, the Fed brings interest rates down to keep the economy going. So the Fed has two mandates. One of them is price stability and the other one is full employment. So those are the two things that they are mandated to do, from Congress. And, price stability means they need to keep inflation in check. And number two, full employment. And right now, I think they're kind of in a position where price stability is more important than full employment. So they're going to keep on raising rates. And what's that going to do? It's going to push us deeper and deeper into a recession. Now, we are not officially in a recession yet because quarter two economic data hasn't come out. A recession is defined as two consecutive quarters of GDP contraction or negative growth. We've had our first quarter with negative growth. In the second quarter, well, we've got 10 more days in the quarter. So we're not going to know for a little bit whether or not we are truly in a recession, but I'm just making the assumption that we are right now already. So what does that mean for the financial markets? Well, debt is going to be more and more expensive. We know the Fed's going to continue to raise rates. We've seen rates go up by 2.25% in the last 6 months, at least the SOFR, the secured overnight financing rate, which a lot of the multifamily products are based off of that rate anyway. Most interest rates in the U.S. are based off of, the federal fund rate. But end of the day, we're going to see debt become more expensive. There's also a lot of volatility in the stock market. As of this morning, the S&P is down 21% year to date. Cryptocurrencies have completely crashed. And, who knows if they're going to go back up again. But what we usually see in recessions is the stock market goes through a cool off period. And we don't know how long that's going to last. The more the Fed raises the rates and the more they cool the economy down, the more likely the stock market is to keep on going down. So what am I doing? Well, of course, I am still investing in real estate. I think that's a smart investment in most economic cycles. In light of the market volatility, though, here are a couple of tips that I have for investing in real estate. So tip number one is going to be buy with less debt. In the current market, I'm looking for deals that have 70% loan to value or less, because we need to make sure that our debt payments are affordable. And if things go down, if we go into recession, if occupancy rates go down or anything else happens, we're still going to be able to make that debt payment. Now, number two is definitely related, adjustable rate mortgages, and a lot of people say, hey, with interest rates going up, why would you invest with an adjustable rate mortgage? Well, the answer is you can get what's called a rate cap or rate cap insurance, which will keep your payments capped at a certain point. Now, this is going to cost money on the front end, but the dirty little secret is when you get a fixed rate loan, 9 times out of 10, they're going to come with a prepayment penalty. And if you sell before the loan terms due, you're going to pay a lot of money on the back end when you sell it. So really what you're doing with an adjustable rate mortgage is you are trading the prepayment penalty for that rate cap insurance. And in general, in the long run, you're going to pay less on an adjustable rate mortgage than you are going to be on a fixed rate mortgage with a prepayment penalty. Number three, I think it's smart right now to invest in larger assets. Larger communities are typically going to have more amenities that are going to be more attractive to tenants. It's going to be easier to use cash flow to do renovations. It's going to be easier to use the cash flow to make improvements. If the sewer line goes up on a 20 unit versus a 200 unit, being able to weather the storm and make those repairs are going to be a lot easier on the larger assets. And because the amenities, they're going to be more attractive to tenants. And if they're competitively priced, they're going to have a higher occupancy than similar properties without the amenities. All right. Next thing I would say is invest in larger metros. And this is tip number 4. If you're keeping track of the numbers, invest in larger metros. Similar to the above, the larger metros are going to have a much larger pool of prospective tenants for your property. And once again, if you competitively price your assets or your leases, you're always going to have higher occupancy. Now, the last thing I'm going to say is don't invest in the hottest markets of the last 5 years. What we've seen in previous recessions, a lot of people say, hey, there might be a bubble in commercial real estate. Maybe there is, maybe there isn't. But there's a lot of markets that have grown extremely fast for no apparent reason. Boise, which is actually really close to where I'm at, has prices have increased almost 100% since the COVID pandemic started, right? So doubling prices in 2.5 years doesn't leave a lot of room for continued growth. And markets like Boise or Phoenix or Austin, I'm not predicting it. I'm just saying they may be overvalued and they may experience a dip in prices. So I would look for metros with solid economics whose growth may have lagged behind those markets. But the rationale for everything, all these 5 tips, is they all serve to lessen the risk in your investment. And I'll point out that a lot of the measures above will also dampen the potential upside on returns, but you can still get double-digit returns in today's market following the 5 points that I just indicated. Now, of course, I believe, and a lot of people believe, rates are going to come back down. Once again, I was talking about economics. The Fed is raising rates right now to bring inflation under control. They have to cool down the economy, bring inflation back down. And once inflation is back down to a low level, I think the Fed's going to have to act to bring rates back down to re-stimulate the economy, because they also have to aim for full employment. And the longer they keep rates high, the more of an impact it's going to have on the economy and the more of the impact it's going to have on employment, right? So I do think the rates are going to come back down. Don't know when and don't know how far, but once they do, I think real estate is going to continue its upward tick and recover any losses that it suffered during the recession very, very quickly. But right now, I think the trick is to weather the storm, put your money into safe investments that are going to continue to grow and go that direction.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.